All right, here we are another day, and this day is super special because today we are starting the Start Here video. I've noticed that when I'm on the market, I have been repeating the steps over and over, and then one day I just stopped. I was like, you know what? Let's just make a Start Here video and a guide to just refer back to. So if you want to understand the strategy, I have it fully laid out for you. Okay. So today is March 14th. It's 2:47 in the morning, and let's get started. So, if you're new here to Mastering the Sweep series, this is honestly the best place to start. In this video, I'm going to walk you through the internal reversal framework, which is a structured way of just understanding how the market moves around liquidity. Many traders see the market as just random movements, but once you just begin to understand where liquidity forms and how price reacts to it, the structure starts to begin to appear. So, what we're going to do today is just break down a sequence that often appears when the market prepares to change direction. Okay? We're only focusing on when the market prepares to change direction. Eventually, I'll create a video when the market wants to continue in the previous direction. But we are only focusing on the change of direction. Are you ready? Let's do it. Okay, so this is my chart. And one thing I love about doing this video is because I use these same exact photos that I created from this structure and all these other just images or setups that I'm going to show you. I included it inside of the book. The logic from that is that my videos will look literally like this. So when you study these videos or when you study the guidebook, it will literally look the same. Okay. So before we just start talking about the framework itself, we need to understand where liquidity forms in the market. If you look here on the chart, where it says equal highs. Equal highs happen when price reaches a similar level multiple times, but not just any level, the high levels. So you can see that I have two orange circles to indicate what I'm talking about. You can clearly see that it reached the equal highs twice. So many traders place their stop losses right above those highs, right here. Okay, so usually their stop losses, when you see SL, that equals stop loss, they will put their stop loss right in this area. Okay, and around this area, this is also called the buy side liquidity. That's just a little vocabulary that you do need to learn. I also have this vocabulary box down here. Okay, so now let's look at the equal lows, the line that's down here. This is, again, our equal lows where price touches a similar low multiple times. So it started here. So that was a previous moment. That's why I changed the color. Why is it previous? It's because it's right before the move really started to consolidate. Consolidate is just moving back and forth and not being able to break out. Break out is in this. Do you see this long bullish candle that is out of this white equal high line? That is considered a breakout. Okay. So, just like the equal highs, traders want to put their stop losses or their SL underneath where it says equal lows. Another important liquidity area is, again, the previous high. As you can see, you don't see an indication of a previous high. I do want to make that clear. But just imagine that this is just, actually, I'm going to show you. Because I'm such a visual person. So if I think that I may need it, I want to most definitely give it to you. So let's just say the market was coming down instead of coming up. Okay. And the market isn't perfect. It may like move a little bit, but then eventually it'll come back down. And then it'll start this pattern. The only difference is between the previous low, which is here, and the previous high, which is here, is just a location. Okay. I hope that I cleared that up for you. So those swing points, actually, I'm going to put that picture back or those images back so I can just say this last thing. So these 2 points, the turquoise color, these swing points often attract stop losses from traders, which is why price frequently move towards these levels before just deciding the next direction, whether it is the previous or the current. Again, just look at the colored circles. Okay, so now that we understand where liquidity wants to go, okay, where the institutional big money traders target those retail traders like us, stop losses to make their true move, okay, in the direction that they want to go. Let's just look at how this whole sequence looks like first. Because as a teacher, I know it's better to show you the ending and then break it down and then come back to the ending so that your brain can understand. Okay, so give me a second. Okay, so we're about to look at the full sequence. With the full sequence, you are waiting for the sweep, the shift in the direction, and the return to your entry. Okay, so let's look at it in the market. Okay, so this is the full sequence of all of the steps to get into the market, to trade. Okay. So once the liquidity is taken, the market often follows a very specific sequence. It's not always perfect and it's not always the same. So you must be able to adapt, one, and to have the right mindset when it's especially when your sequence actually went in the direction, like it went through all of the steps, but it still did not go to your target. You literally have to have an amazing mindset. Okay. All right. So this sequence is what we call internal reversal framework. So this is the sequence and how it looks like. So remember the line that was up here. I'm not going to keep this, but I just want to make sure you see it. So this was our buy side liquidity. The reason why I did not have this here right now is because that the market has decided to take the sell side liquidity. And for this video purpose, I will only show you the buy example. Make sure you get the guide because in the guide I go over both of the sequence, the buy opportunity and the sell opportunity. But in this case, just focus on the buy, okay? Because right now this is only just trying to show you the sequence and how to do it. Okay, so now I'm going to remove this line. All right, so the market is coming down. Okay, it ended up going into that consolidation. The sequence looks just like this. You will first have a liquidity sweep, meaning it will take those stop losses. Those stop losses are taken. Okay. Our next sequence is our displacement, which is in the white box. The move that is going opposite, because where was the direction? It was going down until the displacement pushed it higher. And then after it pushed higher, we did have that change of direction. Remember, this is for the market change of direction. Then eventually, the market ended up coming right back down to our order block, which is what we will consider our entry zone. And then we just ride the wave. Okay, we just ride the wave higher. But not just ride the wave. You have to know your R&R, which is risk to reward. But that's a whole nother video. Okay, just add that to your vocabulary or write that down if you need that. Okay, so when these steps appear together, they can signal that the market may be preparing to reverse or change direction. Okay, so now it's time to just break it down. I'm going to rebuild all of this. Okay, so not only can you see the steps, you will see me build the steps. Okay, and then also comment below, let me know if you like seeing it being built, or do you rather want it to be in a picture form already. Okay, just let me know. Okay, wait, I just said already built in picture form. That's basically the same. So let me know, let me just repeat this. Let me know if you would like it to be pre-built, okay, or for me to break it down with you, how I'm about to break it down. All right, so let's go ahead and remove all of this and start with step one. Okay, so step one is liquidity sweep. Let's just talk about it real quick. So this happens when price move into an area where where liquidity has accumulated. Okay. So for example, if price move above the equal highs, like this. Okay. I already have the words pre-written because if I had to type and create, this video would be a whole hour, and we're not going to be here for a whole hour. Okay, so we have our line. Remember, the market likes to consolidate, and we have multiple touches, and you also know what that stop losses are in both directions. And we're just trying to see what stop losses does the market want to trigger first. Will it be the buy side or the sell side? You can clearly see that the market wanted to go to the sell side first. So I'm going to get my tool, and as you can see right here, all I did was save these symbols and tools so that I don't have to find it every time. And you can do that too. All right. So I'm using my arch, and clearly again, you can see that the market chose to go where? To the sell side liquidity. So I'm going to just extend it over until this bullish candle, because that's basically when the market decided to continue going higher. So I'm just going to stop it here. So the institutional or the big money traders, okay, like the banks, they push the market lower. Because this action collects liquidity. And I know I keep saying this word. You may be like, Kelsey, what is liquidity? The most simple form to know what liquidity is just money. Use that word interchangeably, but if you want to have a more professional vocabulary and you can follow along with other big traders, you got to learn the vocabulary. Okay, so it often provides the momentum the market needs to move in the opposite direction. Because again, you see the market is coming down. Okay, until this area, but we'll get into that later. I just wanted to clear that up. All right, so this is considered the liquidity sweep. Okay, so now we're ready for step two, which is our displacement and change of direction. So basically, in step two, the displacement, this is after the liquidity is taken. Let me show you. Okay. So I kept this pink line and I kept these liquidity equal low equal high lines too, because we just learned that for the stop losses. All right, so after the liquidity is taken, they took all the stop losses in this area. We look for a strong move away from that level, this level. This is our strong move in the opposite direction. So this was a shift that the buyers, okay, the buyers are also called bullish, okay. The buyers are considered the bullish, and then also the green candles. Let me move this over here. This is literally the teacher side coming out of me. And then the sellers, which we're not really talking about today, but this is just for the vocabulary, are the bears, bearish, or the red candles. The if you classify them as the color of the candle, that's like the simplest form to describe them. Okay, so this was the move, the strong move, not just a move, the strong move away from that level. Okay, so I'm going to put the displacement here, and also I'm going to add step 2. Yeah, so the highest wick was basically right here, and the wick is like the thin little line. Okay, so now that I had the change of direction and how this showed, basically the momentum has shifted from the buyers or sellers may now be in control. But in this case, who's in control? The buyers. Because you see more green candles, just using simple terms. It's also going higher, it's going bullish. Okay. And then the displacement is very important because it confirms that the market is not just simply continuing in the previous trend. The previous trend was going down. But step number 3, which is a change of direction. Here's that extra confirmation. So you see this little pink line, okay? I'm going to now remove it, but it's still there, okay? I'm just changing it to this because the momentum has now shifted. They took off the stop losses here, and now they're going to the bullish side. So now we're in officially the change of direction because it's no longer making lower lows. It just created a higher position. Okay? That's just, this is for extra confirmation. So this is considered step 3. This will help you to remove losses if you add this step. And I'm going to extend it because you know it was a pink line here. The change of direction candle, though, is this candle. I just wanted to show you. This candle right here. You can literally see that this green candle, this bullish candle here, officially pushed higher than the last high that they had, showing me that now buyers have strength. Now that we have all 3 steps, we're almost finished. Okay, so let's talk about now, okay, our entry possibility, because we need these 3 steps. Step 1, the liquidity sweep. Step 2, the displacement going away from the previous trend direction. This extra confirmation, which is step number 3. Okay, and let's get into our next and final. Okay, so step 4 and the final step is the return to the order block. Okay, so let's look at it. We are after the displacement and the change of direction. Okay, so first we need to find, where is the candle? Where is the candle where I can put my zone? Because traders often refer to this area as an order block. So here's an extra vocabulary. Order block equals entry. And let me just move this higher, just in case you want a screenshot. And it can look like neat. Alright. So after my displacement, that's where I'm really looking at. I'm looking for the opposite candle of the strong displacement. The most simple form is red or green. Remember, red candle, sellers, green, buyers. So because we have more green candles or buyers, what's the opposite of that? The red or bearish candles. So I'm looking for the last candle that push the market higher. That last opposite candle that pushed the market higher. So in that case, it would be this red bearish candle. So I'm moving my box here. Actually, I'm going to move this here so you can see where I'm talking about. This red candle right there that I put the orange circle in. I'm going to move my box there, and then you can clearly see the market reach back. As you can see also, sometimes the market will go even lower than your zone. That's why you also need to know where to place your stop loss. Here's an amazing stop loss that I place for myself, I look for where the liquidity is, and then I place my stop loss underneath. Just something quick and simple. But now that I have my order block and I have all of my sequence, the market is officially inside my range for me to place a buy order, because I want the market to continue to rise higher. I'll put it here. Okay. Okay. And just the last thing, this creates creates the opportunity for traders to just look for entries aligned with the new direction of the market. All right. So now that we are here, back at the beginning, this is the full sequence. So remember these three words: sweep, shift, return. They form the complete sequence of the internal reversal framework. Okay, let me go back to the market. Again, the sweep, the shift, use this, the shift, okay, and then, hold on, the shift, back to the return. They form the complete sequence of the internal reversal framework. Remember, the goal is not to force the trades, but to observe whether the sequence appears in the market. So I hope that this breakdown was very clear. I hope I added the visuals to help you understand. Take a screenshot or don't, because remember, this is in the guidebook. All right, so now we talked about when to trade. But now let's talk about when not to trade. Okay, just as important as knowing when to trade, it is just as important to know when not to trade. So I created this list for you guys. Screenshot this, okay? Screenshot this. And even if you don't know some of these words, you can look it up on Google. You can ask ChatGPT, or don't, okay? Or just continue watching the journey, because I will go through this and I will show you eventually. But just don't wait though. Take control of your learning while you're in the process. All right. So the market environment may not be ideal when price is choppy and erratic, meaning that it's going back and forth. It has no clear direction. Major news event. You will learn about the folder soon. Okay? But while you're still in the process, if you're kind of confused or you want to know more about the major news events and where you could go to, you can type in forexfactory.com and you can look at the news. Okay? My rule is I do not trade when there is a red folder. Sometimes maybe not even a yellow folder. When it's a gray folder, I'm okay. Or is it gray folder when it's a holiday? I don't remember. But again, we will go through this. Okay. When price is stuck in a tight range, so when you saw like the liquidity bouncing back and forth, don't trade that. Okay. Or when validity is extremely low, when there's not a lot of people in the market, there's not a lot of money in the market, so they are smaller candles. Okay. And one quote that you will always hear is no trade equal capital protected. That's something that helped me shift my mindset because there are days, maybe even a week or weeks, where you are not able to trade. But when that happens, don't think of it as a failure. Think of it as your money being protected. Because if you just try to jump into the market when these conditions are not good or unclear, you have a higher risk to lose money. Your job is to protect your money. Now, the most important, how to study the framework. Okay? Because now that you have the video and you have the book too, I've been talking about the book. Now let's get into it. Okay, so how to study the framework. 3 things. Read each section carefully. Take notes on key concepts and then practice sequence on the charts. If you want to truly understand this framework, the best way to approach it is through study and repetition. You have to practice. It's like you are on a team. It can be a sports team, it can be a dance team, it doesn't matter what team. Or it can be an individual thing. If you do not practice, how can you master it? It's through the repetition where your brain starts to become natural. That's mastery to me. When it's natural to you, you don't have to think about it because it's already ingrained in your mind. Okay. So, again, first, read each section of the guide carefully so you understand the concepts behind the framework. Second, take notes on key ideas. Watch the video again over and over. Read again over and over, especially the sequence of liquidity sweep, displacement, change of direction as the confirmation, and the return back to that order block or entry. And then third, practice identifying the sequence on real charts. You saw that I was using TradingView. I'm not promoting it at all, but that's just a free platform that you can practice today on. Trading is a skill, and like any skill, it improves through observation and repetition. So, I have a book that I have been mentioning, Mastering Sweep Volume 1, which walks through this framework step by step with visual examples of the same visual examples that I just showed you here. I used the same photos. Well, it's a photo on there, but I set it up, screenshot it, added it to the book. So you can use both of them interchangeably. And if you would like to study the full guide, you can find it on the website of Nueva Voz. Just type in nuevavoz.co and type in your email and receive this free guide. Okay, so we are wrapping up. So each week, I also publish market studies where we analyze real charts and practice identifying these patterns together. Remember, the market appears random until structure becomes visual. Meaning, when you look on the chart, it may seem like it's rocket science and you just don't understand. It's so random. But once you have the structure, and you do now because you watched the video and you're going to get that free guide that all you have to do is just add your email to. It will start making sense. You will start being able to see it. But thank you so much for watching. Make sure you comment one thing that you learned today because I want to see. I want to see what can I do to help you guys more. And yeah, I will see you guys in the next study session on Thursday. Have an amazing day.